Services Committee is gathering to hear from housing officials as they talk about the nation's housing finance market and the need for Congress to help with housing finance reform. Live coverage here on C-SPAN 3.
Reform Act of 2018. Before I recognize myself for an opening statement, I think I wish to recognize, I'm having on fairly good authority, we are setting at least 3 different records today. Number one, I think this is the single largest witness panel that we have ever impaneled, at least in the 16 years I've been on the House Financial Services Committee. In fact, at the moment, I think the witnesses outnumber the members. Hopefully, we will remedy that situation soon. And then I have it on good authority that we are the only committee that is working today. And if it was in the budget, I would have T-shirts printed to memorialize that particular incident. So now that I've recognized our historic record, I recognize myself for 5 minutes to give an opening statement. 3 months ago, this committee marked the 10-year anniversary of the federal takeover of the failed housing government-sponsored enterprises, Fannie Mae and Freddie Mac. As I described it then, that day of failure will live on in economic infamy. That anniversary also marked and continues to mark an opportunity to open the next chapter in America's housing finance system, an opportunity to end a 10-year-long unsustainable conservatorship of the GSEs and once and for all fix the private gain, public loss model of corporate subsidization that is embodied by the GSEs. On September 6, my colleagues across the aisle, Mr. Delaney of Maryland and Mr. Himes of Connecticut, and I released publicly a discussion draft of the Bipartisan Housing Finance Reform Act of 2018, which offers a bipartisan path forward to fix our housing finance system through a grand bargain. Codify an explicit government MBS guarantee into law. Couple this with an accountable and effective affordability program, and in exchange, 1, place the taxpayer in a catastrophic loss position only, 2, diffuse credit risk beyond two GSEs, and 3, create robust market competition. Our legislation will repeal the GSE's charters, permanently ending their monopoly, and transition to a system that allows qualified mortgages backed by an improved private credit enhancer with regulated diversified capital resources to access the explicit full government securitization guarantee provided by Ginnie Mae. I thank my colleagues from across the aisle for their diligent work on this, and I want to thank the witnesses here today to offer their valuable feedback on how to improve the discussion draft. And I thank the witnesses for their patience since this hearing had to be rescheduled at least twice due to the passing of President Bush. It is my hope that our hearing today will mark one important step forward towards a bipartisan solution for an area of public policy that has proven resistant to legislative reform. Make no mistake, this is both necessary and I also believe urgent, the reforms that we are discussing today. I strongly disagree with anyone that characterizes the status quo as good enough, or feels that any comprehensive reform effort is not worth the risk of upsetting the status quo we have today. This is an increasingly dangerous status quo, and I fear the housing market may suffer for it in the future without meaningful, certain, and sustainable housing finance reform. Failure to provide reform will lead the mortgage finance markets to repeat the mistakes of the past. The underlying risks in the mortgage market are still present, especially since the GSEs, without capital and backed by taxpayers, remain the focal point of the mortgage funding market. Until the housing sector is put on a sustainable path, we will continue to see affordability concerns as potential homeowners are priced out of markets, loosening underwriting standards past what would be considered prudent, overextension of mortgage credit, and the continued concentration of both control and risk in too big to fail government-sponsored enterprises. These are the classic ingredients of a housing bubble, a volatile mix of imprudent lending and negligible accountability. And as we saw 10 years ago, when that bubble burst, it is hard-working Americans who feel the pain and pay the price with their taxpayer dollars to clean up the mess. The next Congress has an opportunity to pursue generational reform of the housing finance system, a legislative solution that fixes what is broken, reforms what is needed, and gives Americans a world-class housing finance system that still preserves liquidity and the 30-year fixed-rate mortgage, builds a more effective, affordable housing framework, encourages competition and innovation, and protects taxpayers against systemic risk. Our discussion draft was crafted as one way to achieve that legislative solution, a plan that can serve as a foundation of bipartisan compromise based on harnessing the well-known and well-understood parts and concepts of today's system, but is certainly not the only way. So we hope that our witnesses today can provide us valuable feedback on the draft and what the next Congress needs to consider in tackling GSE reform legislation. We should also remember that while this work is difficult, it is vital. And we should also remember that should the next Congress choose not to act, Dr. Mark Calabria, President Trump's nominee for FHFA director, once confirmed, will certainly have the power as either conservator or regulator of Fannie Mae and Freddie to unilaterally shape the path of housing finance reform for 5 years or perhaps 10 years. Simply put, reforming our broken GSE model is the right thing to do, and now is the right time to do it. I now yield to the gentleman from Michigan, Mr. Kildee, the vice-ranking member, for 1 minute.
Thank you, Mr. Chairman. Thank you for yielding, and thank you for holding this hearing. I've been here 6 years. I know many of you have been here longer than that. We've talked about GSE reform ever since I came here, and finally here on our last day of this session, we have a discussion draft, and I am glad to see that there's bipartisan support for this effort, but there's still a number of issues to be addressed. Homeownership opportunities should exist for low and moderate income families in this country, and GSE reform can address this by an explicit requirement for a duty to serve. Now, this proposal doesn't go far enough to address that. I'm interested in the panel and your opinions on this. There are 10 of you. You can offer at least 10 opinions on that subject. Some of you might have more than one. Look, I have a lot of concerns that if we focus only on the structural map of housing finance without addressing the system's need to assure affordable mortgages for creditworthy borrowers, will fall short. I don't believe that we go far enough with this particular draft, though I'm happy to see it come forward. I'd also be remiss in not mentioning that here on this last day of this Congress, there is at least some acknowledgement by some who have not acknowledged the specific need for the government to play a role in backstopping the housing market. That's a step forward, and I hope it's one that we can carry into the next Congress. So thanks for being here. This is an important subject. It's one that we are long overdue in addressing, and it's my hope that this hearing and this discussion draft will provide us the space to set a marker, and hopefully this committee can take this subject up when we reconvene in January. So thank you very much, Mr. Chairman. Thanks for my colleagues for putting this discussion draft together, and for the witnesses for being here. We're very grateful. I yield back.
Gentleman yields back. Today we welcome 10 witnesses, count them, 10 witnesses to the committee. Mr. Ed DeMarco is president of the Housing Policy Council and former director of the FHFA. Mr. DeMarco has testified before us before. He received his BA in economics from the University of Notre Dame and his PhD from the University of Maryland. Ms. Diane Yentl is president and chief executive officer of the National Low Income Housing Coalition. She received her BA from the State University of New York at Stony Brook and her master's in social work from the University of Texas at Austin. Mr. Vince Malta is president-elect of the National Association of Realtors. He received his undergraduate and law degree from the University of San Francisco. Mr. Robert Brooksmith is president and chief executive officer of the Mortgage Bankers Association. He received his BA from Yale University. Mr. Jerry Howard is chief executive officer of the National Association of Home Builders. He earned his VA from the University of Vermont and his JD from the University of South Carolina. Ms. Lindsay Johnson is president of the U.S. Mortgage Insurers. She received her MBA from Georgetown University. Mr. Alex Pollock is a Distinguished Senior Fellow of Financial Markets at the R Street Institute. Mr. Pollock received his bachelor's from Williams College and his master's from the University of Chicago and an MPA from Princeton University. Dr. Norbert Michel is director of the Center for Data Analysis at the Heritage Foundation. He received his BA from Loyola University and his doctoral degree from the University of New Orleans. Mr. Don Calcaterra Jr. is president of Local Lending Group Loans and vice president of the Community Home Lender Association. He received his BA from Villanova University. Mr. Rick Stafford is president and chief executive officer of Tower Federal Credit Union and is testifying today on behalf of the National Association of Federally Insured Credit Unions. Mr. Stafford received his BA from Adrian College and his master's degree from Walsh College. Without objection, the witnesses' written statements will be made part of the record. So, Mr. Marco, we will start with you. You are now recognized for 5 minutes to give an oral presentation of your testimony.
Thank you, Mr. Chairman. Good morning, members of the committee. Mr. Chairman, thank you for inviting the Housing Policy Council to be part of this discussion. Before I go further, I want to thank you for your long service to our country and your pursuit of a sound housing finance system. I also want to recognize Congressman Delaney and the other members of this committee whose time in Congress is coming to a close, and thank you for your service to our nation. The Housing Policy Council believes that the bipartisan housing finance reform legislation we are here today to discuss is an important advancement in this long-running legislative effort to modernize our housing finance system and replace the pre-crisis model that failed us so badly. I want to acknowledge Congressman Delaney and Himes for their original reform legislation with then Congressman Carney, which contained significant forward-thinking reforms, and for working with the chairman on this compromise draft. I also want to thank Ranking Member Waters for the contributions made in her 2014 reform proposal, which also contributed to identifying a path to finally achieving bipartisan housing finance reform legislation. One of the things I should note, and that I develop further in my written statement, is how this discussion draft draws upon key elements of the Waters and Delaney-Carney-Himes bills and the chairman's earlier bill, the PATH Act. Briefly, I'll make several big-picture comments about the discussion draft. First, the principles set forth in the bill are widely shared by other major housing finance reform legislation. It's shared by the Housing Policy Council and shared by most, or if not all, of my fellow panelists. The Housing Policy Council believes this bill delivers on these principles. Second, in the bill's summary, the sponsors state the following. The overarching philosophy of the Act is to create an equal playing field across different ways to finance a single-family mortgage, allowing risk to be allocated to those entities which are best able to manage it and avoid too-big-to-fail institutions dominating or restricting access to the mortgage market. HPC believes this is the right goal. Third, the bill distributes critical risk management functions across distinct industry stakeholders and aligns the regulatory regime to the assignment of risk and functions. Fourth, the bill has an important placeholder for further work on affordable housing. HPC supports the funding proposal and also welcomes fresh ideas about how to most effectively use these dollars to create sustainable homeownership opportunities for families striving to be homeowners. As the next Congress takes up the challenges of carrying on this effort, I will close with two comments. First and foremost, this work must be done. The remaining incomplete work from our financial crisis cannot be completed without Congress, nor should it be. And as this committee prepares to push forward again next year, HPC asks that you please consider the Federal Housing Administration and other government lending programs as you do. They are critical elements of our system and need to be part of the solution. Thank you.
Thank you. And Ms. Unal, you are now recognized for your testimony.
Thank you. Chairman Hensarling, Ranking Member Waters, and members of the committee, thank you for the opportunity to testify today on ways to alleviate the housing crisis through comprehensive housing finance reform. I'm Diane Yantel, President and CEO of the National Low Income Housing Coalition. We are solely dedicated to ensuring that the lowest income people in our country have safe, accessible, and affordable homes. Our country's affordable housing crisis has reached historic heights, most negatively impacting the lowest income people, those who earn 30% or below the area median income or are below the poverty line. So for example, in Dallas, an extremely low income renter is a family of 4 with 2 working parents earning less than $25,000 a year combined, a low income senior with income of no more than $16,000, or a single person with a disability relying on only $9,000 of annual income from SSI. Nationally, we have a shortage of over 7 million homes affordable and available to these lowest income people. In other words, for every 100 of the lowest income seniors, people with disabilities, families with kids, there are just 35 homes that are affordable and available to them. No congressional district has an adequate supply of available rental homes affordable to its lowest income residents. Chairman Henserling and Ranking Member Waters, in both the 5th District of Texas and in California's 43rd District, there are fewer than 2 affordable homes available for every 10 of the lowest income renters. This shortage results in nearly 8 million of the lowest income renters being severely cost burdened, paying more than half of their incomes to keep a roof over their heads. So when you have such limited income to begin with and you spend more than half of it on your rent, you are one financial emergency, a broken down car, a missed day of work, a sick child, away from not being able to pay the rent, facing eviction and possible homelessness. And in the meantime, you make impossible choices between paying for needed medication or healthy food or paying the rent. The private market cannot on its own solve for the housing needs of the poorest seniors, people with disabilities, and working families. Without government intervention, decent and affordable homes cannot be reliably built or operated and maintained at a price that the very lowest income people can afford. Federal subsidies are necessary to fill the gap, but funding for such subsidies have been declining for decades. The National Housing Trust Fund, funded through a small assessment on Fannie Mae and Freddie Mac's business, was created precisely to meet this need, to build and preserve affordable homes for the lowest income people. The Housing Trust Fund's first allocation of $174 million has so far allowed 43 states to build or preserve 138 projects with over 1,500 Housing Trust Fund assisted homes. These homes house some of our country's most vulnerable people, from people previously experiencing homelessness to youth exiting foster care, survivors of domestic violence, people with disabilities, veterans, and others. Given the program's success and the overwhelming need, efforts to reform the country's housing finance system must significantly expand investments in the Housing Trust Fund, as major bipartisan proposals in recent years have done. Chairman Henserling, we appreciate that your draft legislation provides for an affordability fee that could contribute to an overall increase in funding for affordable housing. And we also appreciate your and Congressman Delaney and Himes's stated commitment to, quote, substantial funding in support of programs such as the National Housing Trust Fund and the Capital Magnet Fund. But we are concerned with the lack of details about the size of the fee and the use for the funds generated, and we are also concerned about the proposal to eliminate other important affordable housing requirements without an adequate replacement. So NLIHC urges that any housing finance reform legislation, 1, provide a minimum of $3.5 billion annually to the Housing Trust Fund, 2, to expand the current 4.2 basis point assessment to a minimum of 10 basis points in order to do so, 3, to ensure that dedicated housing funds don't compete with other appropriated housing programs. The Housing Trust Fund must remain off budget and separate from the appropriations process. And 4, to ensure that the expansion of the Housing Trust Fund is part of a broad commitment to ensuring access and affordability throughout the housing market with enforceable and measurable mechanisms allowing access to credit for historically underserved people and communities. As Congress moves forward with housing finance reform legislation, we urge that the critical housing needs of the lowest income renters who cannot be reached through the GSE's regular course of business or by the private sector alone be central in the solutions put forward. Thank you for the opportunity to testify before you today, and I look forward to answering any questions.
Ms. Melton, you are now recognized for your testimony.
Chairman Henserling, Ranking Members Waters, members of the committee, my name is Vince Malta. I'm a third-generation realtor and CEO of broker of Malta & Company Incorporated. I have over 43 years of service and experience in the San Francisco area. I'm currently the National Association of Realtors President-elect. I'm testifying on behalf of nearly 1.3 million realtors who thank you for the opportunity to present NAR's views on the Bipartisan Housing Finance Reform Act of 2018. NAR is America's largest trade association where realtors are involved in all aspects of both the residential and commercial real estate industries. While the housing market has generally improved since the financial crisis, housing finance reform remains incomplete. NAR urges lawmakers to pass comprehensive housing finance reform. It is critical that any reform system ensure for a liquid national mortgage market that is resilient to stress and which supports the homeownership needs of middle-class Americans. Thoughtful reform of the secondary mortgage market will not only support these needs for creditworthy Americans, but also safeguards the interests of taxpayers. Realtors thank Chairman Henserling and Representative Delaney for introducing the Bipartisan Housing Finance Reform Act of 2018. Realtors appreciate the Chairman's diligent work and negotiations over the past several months that has resulted in a discussion draft containing a series of compromises. NAR believes the discussion draft contains many provisions that should serve as the backbone for comprehensive housing finance reform. Those components include an explicit government guarantee, regulatory flexibility, and strong and reasonable regulatory authority. NAR strongly supports the proposal's language to provide an explicit government guarantee for mortgage-backed securities. Explicit government backing of mortgage-backed securities was required to instill confidence in potential investors. Without investor confidence, the ability to raise capital and provide liquidity to the secondary mortgage market will be severely limited. An explicit government guarantee is essential to ensure qualified, creditworthy borrowers have access to affordable mortgage credit and to preserve broad access to a 30-year fixed-rate mortgage. Without government backing, consumers will pay much higher mortgage interest rates, and mortgages will, at times, not be readily available, as has happened in jumbo and commercial real estate markets. NAR generally supports the overall flexibility given to Ginnie Mae and the FHFA to set various rules and standards for market participants. NAR agrees that prudent underwriting standards, sound regulatory guidelines, and strong oversight are essential guardrails needed to protect taxpayers in any future system. NAR also supports a qualified mortgage-like definition to be used as part of the underwriting process for government-backed mortgages. The discussion draft further creates the crucial role of strong regulators of the secondary mortgage market. Lack of regulatory oversight was one of the many issues that led the country into the Great Recession. Providing Ginnie Mae and FHFA with proper oversight tools creates a more transparent mortgage market that can operate in a robust and safe and sound manner. Realtors thank the chairman for his leadership on creating a bipartisan housing finance reform proposal, as well as other important issues such as regulatory reform and flood insurance. NAR believes a comprehensive and bipartisan housing finance approach is necessary to ensure for a safe and vibrant housing market. NAR strongly supports many of the discussion draft's provisions and believes the foundation for the future housing finance system, again, must include an explicit government guarantee, regulatory flexibility, as well as strong and reasonable regulatory authority. NAR looks forward to continuing to work with members of the committee to mend and improve a housing finance system that has served us well for many years. Thank you for the opportunity to testify, and I look forward to answering any questions.
Ms. Brooksby, you are now recognized for your testimony. I think you need to get the microphone turned on and a little closer to you, please.
Chairman Henserling, Ranking Member Waters, and members of the committee, thank you for the opportunity to testify on behalf of the Mortgage Bankers Association. My over 30 years of experience in real estate finance give me unique appreciation for the complexity of the housing finance system, as well as the importance of ensuring that it operates in accordance with a well-calibrated regulatory framework. On behalf of MBA, I commend Chairman Henserling as well as Representatives Delaney and Himes and their staffs for developing and releasing the proposal being discussed today. The housing finance system requires structural reforms that will ensure a stable, liquid secondary market. Comprehensive legislation is essential for such reforms, and this bipartisan legislation represents a strong step forward in advancing this effort. The 2008 financial crisis exposed fundamental problems in the GSE's business models, as well as weaknesses in the regulatory framework in place at the time. 10 years later, we still have not determined how or if the GSEs will be reformed. Only by enacting comprehensive legislation can we realize the full benefits of a diverse, competitive primary market and a vibrant, liquid secondary market. Reform should proceed without delay. This proposal focuses on several principles, including liquidity across mortgage markets, borrower access to credit, lender access to the secondary market, taxpayer protection, consumer choice, and a smooth transition. Many of these principles align with what MBA has long supported. In particular, the draft recognizes that any reforms must meet the need of the broad array of participants in the housing finance system, including borrowers, lenders, investors, and taxpayers. Competition is also woven throughout the discussion draft. MBA believes that robust competition in the secondary market promotes a highly competitive primary market, which in turn provides borrowers with greater choice at affordable prices. Additionally, the draft includes numerous provisions that prohibit discrimination based on lender size or business model, which we agree is of paramount importance. MBA applauds the inclusion of an explicit federal guarantee on eligible mortgage-backed securities in the single-family and multifamily market. In addition, the development of an insurance fund, the private capital reserves, is an appropriate step to ensure the government is compensated for the credit risk it takes and to create a buffer to absorb losses ahead of taxpayers in the event that a private credit enhancer becomes insolvent. The restriction on vertical integration preventing Ginnie Mae issuers from also operating as private capital enhancers should protect against market distortions that favor larger institutions, though this restriction could be enhanced by expanding it to include a clearer prohibition on any entity simultaneously undertaking both primary and secondary market activities. There is an important distinction in the structure of the conventional secondary market, which is served by the enterprises and operates under a guarantor model, relative to the structure of the government or Ginnie Mae secondary market, which operates under an issuer model. Though there are merits to both structures, MBA continues to believe that a guarantor model is far more appropriate for the conventional market. One of the greatest challenges to enacting comprehensive reform has been conflicting reviews on how best to ensure widespread availability of affordable housing, particularly to low and moderate income households. Affordability in the housing market is hampered by low inventory and home prices that are rising faster than wages in many areas of the country, among other issues. While this draft does not currently contain specific legislative text, it does include principles regarding the provision of affordable housing. They focus on targeting and delivering aid to those most in need of assistance. MBA supports the need for strong affordable housing provisions and recommends that the authors build out and strengthen this section. As the enterprises continue into their second decade of government conservatorship, it is more critical than ever that policymakers tackle the remaining work of housing finance reform. Access to affordable, sustainable housing is a necessity for all Americans, and as such, it requires a system of financing that is robust in all parts of the country through all parts of the credit cycle. Legislative reforms of the enterprises offer the best path to this desired end state. Again, thank you, Chairman Henserling, Ranking Member Waters, and Representatives Delaney and Himes for your thoughtful contribution to this effort and for the opportunity to testify.
Mr. Howard, you are now recognized for your testimony.
Chairman Henserling, Ranking Member Waters, Merry Christmas. Members of the committee, Happy Holidays. NAHB is very proud to have this opportunity to appear here today. And Mr. Chairman, Mr. Delaney, Mr. Himes, we applaud you for advancing the debate on housing finance reform. NAHB remains a staunch supporter of comprehensive housing finance system reform. We believe that comprehensive reform must come through Congress and focus on fixing the structural flaws that still persist after the Great Recession. Comprehensive legislation is the only way to ensure a stable housing finance system, preserve access to credit, and protect the taxpayers. While GSEs are not granted an explicit government guarantee by their charters, Treasury's current backing has turned the enterprise's historical implicit guarantee into an explicit federal government guarantee, which means the taxpayers right now are at risk of loss due to a failure of the underlying mortgage loans. On a positive note, FHFA has taken steps to reduce taxpayer risk on such loans through credit risk transfer programs that shift a meaningful portion of the credit risk to private investors. Recently, NAHB joined 28 other organizations in urging policymakers to lock in recent reforms to the enterprises and complete additional reforms through legislation. The letter emphasized that regulatory reforms put in place during conservatorship must be retained, and stakeholders must continue to press for permanent reform that fixes the structural flaws of the enterprises, which contributed greatly to the financial crisis. The administration has signaled its intent to make additional reforms through regulation in the absence of congressional action. They propose a strong commitment to a level playing field between the enterprises and private market participants. We look forward to the opportunity to work with the new FHFA director and other administration officials to offer thoughts on reform efforts and ideas for moving sustainable reform forward. NAHB believes that any administrative reforms should be carefully thought through and implemented in a way that will not adversely impact home mortgage liquidity or affordability in any area of the country. We think it is particularly important for FHFA to provide notice and comment opportunities on proposed administrative changes and to provide adequate transition periods to allow market participants to adjust to new guidelines and circumstances. Ultimately, though, congressional action on comprehensive housing reform is the only way to achieve effective and a sustainable solution. Short-term regulatory solutions or piecemeal legislative steps are simply not adequate. NAHB appreciates your efforts, Mr. Chairman, to develop the bipartisan housing reform legislative framework. We are pleased that this legislation would establish an explicit federal government backstop for a key portion of the secondary market. The legislation would also extend use of the existing Ginnie Mae securitization platform to issue mortgage securities backed by qualifying conventional loans, in addition to issuing Ginnie Mae securities backed by government-insured mortgages. NAHB believes that there is significant advantage to employing a known and successful guarantee entity, although substantial upgrades will be needed for Ginnie Mae to successfully perform in this expanded role. NAHB is pleased that this approach would preserve and build upon the successful multifamily mortgage programs of the GSEs. These programs continue to address key market needs and have not experienced any of the problems associated with the enterprise's single-family endeavors. We look forward to working with the committee to flesh out the details of this further. With regard to affordable housing, NAHB believes that affordability should be broadly defined to include workforce needs as well as the usual very low-income targeting. Again, NAHB welcomes the opportunity to work with the committee on this. In terms of regulatory oversight, NAHB applauds the draft for proposing that the regulator be governed by a board with appropriate expertise to deal with multifaceted issues and challenges that will be posed by this new system. Board governance would help avoid the potential for extreme and abrupt changes in policy that are possible under the existing single director regulatory regime. Finally, an important element that is not addressed in this or other legislative proposals is the protocol for establishing appraisal standards and guidelines. We believe that such provisions should not be left exclusively to the system guarantors, as is currently the case. Such an arrangement inappropriately puts appraisers in their task achieving the most accurate estimates of value. The new system should include a means for all mortgage market stakeholders to contribute to the system's appraisal standards and to allow appraisals greater latitude in completing their assignments. Overall, NAHB is encouraged that the recent reform plans have many common elements and that agreement on key portions of reform is emerging. We look forward to working with this committee in the next Congress to find remaining solutions to the issues. Thank you, Mr. Chairman.
Thank you, Mr. Calcaterra. You are now recognized for your testimony.
Good morning. Chairman Henseling, Ranking Member Waters, and members of the committee, it is an honor to testify before you today. My name is Don Calcaterra, Jr. I am president of Local Lending Group, an independent mortgage banker in Troy, Michigan, and I appear before you today as vice president of the Community Home Lenders Association, CHLA, the only national association exclusively representing independent mortgage bankers, also known as IMBs. IMBs are vital to our housing finance system. Small businesses providing choice as well as access to mortgage credit to families in the communities where we live. When the large banks pull back from lending, like they did during the Great Recession, it is IMBs working with Ginnie Mae and the GSEs that stabilize neighborhoods by providing home loans, especially to qualified, low and moderate income, minority, and underserved home buyers, and afterwards servicing those loans in a personalized manner. We commend Chairman Henserling and Representatives Himes and Delaney for a thoughtful and detailed piece of legislation. There are many positive provisions in this bill from a small lender perspective, notably requiring a cash window for small lenders, pricing parity based not just on guarantee fees, but on fees charged by credit enhancers, and language that seeks to create a bright line distinction between the primary and secondary markets. At the same time, we have two specific concerns about the bill. First is the proliferation of additional guarantors, or credit enhancers as the bill calls them. CHLA laid out our detailed concerns about such an approach in our appearance at the July 2017 Senate Banking Committee Small Lender GSE hearing. I also note that all 6 small lender groups testifying oppose the authorization of new guarantors. Our second concern is the use of the Ginnie Mae model. CHLA was among the earliest proponents of using the Ginnie Mae platform in a pilot to test a Ginnie Mae guarantee on conventional loans backed by a 100% incontestable guarantee from private mortgage insurers. Historically, Ginnie Mae has been an efficient, transparent mechanism to sell servicing retained government loans to the secondary market, so it seemed logical and less disruptive to try its platform. However, turning over the entire conventional market to Ginnie Mae is quite different than testing a pilot. More importantly, small IMB issuers are experiencing tightening that is disproportionate for an entity like Ginnie Mae, which has almost no credit risk. CHLA supports prudent steps to ensure that Ginnie Mae carries out its supervisory and financial responsibilities. However, smaller IMB issuers increasingly are experiencing Ginnie Mae tightening actions, making it difficult for issuers to deliver affordable mortgage loans to consumers and causing significant concern among issuers and warehouse lenders. Examples include Ginnie Mae limiting the levels of loans that can be sold by lenders that meet all published net worth liquidity standards and delinquency ratios, and demands that firms significantly increase net worth and liquidity ratios above transparent posted requirements. These actions will significantly reduce service options and credit access by eliminating local mortgage providers. We expect Ginnie Mae to prudently supervise all issuers, but believe any tightening actions should be based on an objective standard driven by actual financial risk to Ginnie Mae and balanced with consumer impact. An example of tightening action that adversely affected credit is Ginnie Mae's decision a few years ago to end the Targeted Lending Initiative, a program that made home buying more affordable for low to moderate income and minority families. In the context of GSE reform, these concerns make the use of a Ginnie Mae model more problematic. CHLA is gathering input from small issuers on recent Ginnie Mae supervisory actions and plans to release a comprehensive report early next year offering recommendations on balancing the dual goals of strong financial supervision and maximizing consumer choice and access to mortgage credit. In closing, we commend the committee's efforts. It would be ideal for Congress to enact a balanced housing reform bill into law. However, if it can't do so now, our written statement offers a path forward. FHFA and the Treasury should take administrative action in order to continue the significant progress that has already been made to date to reform the GSEs. Thank you for your opportunity to participate today. CHLA looks forward to continued dialogue with committee members on housing finance reform, and I look forward to your questions today. And in my last 30 seconds, on a personal note, I hope you'll all find yourself among the comfort of family and friends this holiday season. Thank you. Thank you.
Thank you. Mr. Stafford, you're now recognized.
Good morning, Chairman Henseling, Ranking Members Waters, and members of the committee. My name is Rick Stafford, and I am testifying today on behalf of NAFCU. I am President and CEO of Tower Federal Credit Union in Laurel, Maryland. Thank you for the opportunity to appear before you today to talk about the Bipartisan Housing Finance Reform Act and the important issue of housing finance reform. NAFCU has been active in the housing finance reform debate and has established certain principles that are important to credit unions and should be considered in any reform effort. I outlined these in my detailed written testimony and would like to highlight a couple key points here today. It is utmost important that a healthy, sustainable, and viable secondary mortgage market for credit unions is maintained. To achieve this, credit unions must have guaranteed access to the secondary mortgage market. Further, we do not support a pricing structure based upon loan volume, asset size, or any other issue that will put our member owners at a disadvantage. Credit unions must have access to pricing that is focused on quality, not quantity. As we discuss reform, it's important to note that the current system, while not perfect, is working for credit unions. However, we recognize existing challenges with the current model and appreciate the opportunity to offer our thoughts on reform, including the bill before the committee today. NAFCU and our member credit unions would like to thank Chairman Henseling, Representative Delaney, and Himes for their thoughtful, bipartisan efforts to advance the housing finance reform debate. There are a number of positive provisions in this bill, including strong capital standards, a guaranteed cash window for small lenders, permitting small lenders to retain servicing rights on their loans, maintaining a vibrant FHLB system, preserving and enhancing the use of credit risk transfer transactions in the common security platform. NAFCU is also pleased to see the efforts to set the role of private credit enhancers, including the requirement of FAFA establish a capital framework for PCEs, the prohibition of PCEs from holding mortgages as portfolio investments, and providing a bright line distinction between PCEs and issuers of securities. NAFCU recognizes the importance of a limited government role in the housing finance system, particularly in the form of an explicit government guarantee on the payment of principal and interest on mortgage-backed securities that are reinforced by credit enhancements. A limited government role also means that many of the operational details of the housing finance system should be left to the entities and the regulator. For example, Congress should not be mandating requirements such as a minimum down payment of at least 5% for eligible mortgages to be guaranteed by Ginnie Mae Plus. This is a requirement that may be put in place by the regulator and should be flexible to accommodate for economic fluctuations in the housing market. NAFCU's principles include the need for a single, independent regulator that provides stability and confidence in the market. We are concerned that the Ginnie Mae FHFA relationship envisioned in the bill could become a de facto dual regulator structure that has the potential to create confusing and conflicting directives in the market. NAFCU and our member credit unions also have general concerns about the overall cost and workability, including the transition to any new housing finance system. Although great strides have been made to address these concerns in the bill, we urge general caution and enhanced flexibility as major changes are contemplated to the housing finance system to ensure reform is done right. It is also critical that any increased cost associated with establishing a new housing finance system be minimized as to not increase the cost of borrowing for consumers, not serve as a barrier to entry for small lenders, and not allow large lenders to dominate the system. As Congress considers reform, Treasury and the FAFA are also evaluating potential administrative reforms. NAFCU has encouraged the FHFA to work with the Treasury to allow GSEs to begin rebuilding capital. Although NAFCU supports a legislative solution that codifies some of the improvements made during conservatorship, we also support administrative reforms in the meantime. We look forward to working with the new leadership at FHFA on these issues and more. In conclusion, it is vital that the credit unions continue to have guaranteed access to the secondary market and fair pricing on the quality of their loans. We are pleased to have thoughtful, bipartisan initiatives that seek to advance the housing finance reform debate. NAFCU stands ready to work with Congress, the administration, on the future of housing finance. Thank you for the opportunity to provide our input on this important issue. I welcome any questions.
Thank you. Ms. Johnson, you're now recognized.
Chairman Henseling, Ranking Member Waters.
I'm not sure the microphone is on. If it is, it needs to be pulled closer to you.
Thank you. Chairman Henseling, Ranking Member Waters, and members of the committee, U.S. Mortgage Insurers appreciates this opportunity to come before you to discuss the housing finance system and opportunities for reform, and to comment on the housing finance reform proposal released by Chairman Henseling, Congressman Delaney, and Congressman Himes. The Bipartisan Housing Finance Reform Act of 2018 is an important marker in the conversation on housing finance reform because it acknowledges the need for an increased private capital in the conventional market to better shield taxpayers from mortgage credit risk, as well as the need for an explicit government backstop to ensure market liquidity and consumer access. For over 60 years, private mortgage insurance has helped more than 30 million creditworthy borrowers qualify for home mortgages with modest or small down payments. Just last year alone, USMI members helped more than 1 million families become homeowners, nearly 60% of whom were first-time homebuyers, and more than 40% had annual incomes of less than $75,000. We are very proud to help these hardworking middle-income households achieve homeownership. Our members have decades of experience underwriting, insuring, and dispersing mortgage credit risk. Private MI is one of the only forms of permanent private capital that's available through all market cycles and specifically dedicated to the housing finance system. Following the financial crisis, the industry made significant improvements, including new capital and operational standards under the private mortgage insurer eligibility requirements that were issued by the GSEs and approved by FHFA, and new master policy contracts that clarify how and when MIs pay claims. MI significantly reduces taxpayer risk exposure by transferring at origination a substantial portion of mortgage credit risk at the individual loan level to companies that are backed by private capital. Because the credit risk protection attaches to the loan from the very first day that the mortgage is originated, it travels with the loan wherever it goes, whether that's onto a lender's balance sheet, to an investor, or into a securitization pool. Further, MI is one of the only forms of credit enhancement that's compatible with a number of different housing finance reform proposals, including the discussion draft that relies on Ginnie Mae, or a cooperative model as proposed in Ranking Member Waters' 2014 Home Forward legislation. It also means MI is accessible to lenders across the country, from big to small banks, independent mortgage banks, and credit unions, both large and small. The discussion draft affirms fundamental bipartisan reform elements which align with USMI's principles for housing finance reform, including to further protect taxpayers, to promote stability within the financial system, to ensure accessibility for creditworthy borrowers and all lenders, and to foster greater transparency. We do have several recommendations for the discussion draft to increase taxpayer protection and to ensure that consumers will have access to affordable mortgage credit. First, any future system should rely on loan-level credit enhancement done at origination by entities that are able to actively manage mortgage credit risk through all market cycles. USMI commends the approach to use the Ginnie Mae system in the discussion draft, including its separation of the roles of issuer and credit enhancer, which reduces systemic risk without reducing borrower-lender access. Today, Ginnie Mae and its issuers are familiar with, recognize the value and utility of, and operate using loan-level insurance through FHA, VA, and RHS programs. USMI recommends expanding this approach for the conventional mortgage market by using loan-level, entity-based credit enhancement to cover all expected credit loss. Loan-level credit enhancement is needed to actively manage credit risk, reduce losses at the individual borrower level, afford lenders the flexibility for secondary market execution, and ensure quality loan manufacturing. A government guarantee should also be conditional on private capital covering all expected losses, so that this guarantee is only drawn on in catastrophic scenarios. Second, to further protect taxpayers and foster transparency, we must reform the 100% taxpayer-backed FHA and establish a coordinated and consistent housing policy between the conventional and government-insured markets. Without addressing these markets, the discussion draft would merely shift rather than reduce mortgage credit risk in the housing finance system. Lastly, to promote stability, we must establish a level playing field and increase transparency and accountability by separating the issuer and credit enhancer roles at the GSEs. As Congress debates housing finance reform, we're encouraged by the strong bipartisan support for increasing private capital to protect taxpayers and the federal government. I am very proud to represent an industry that's helped millions of families become homeowners. USMI strongly believes the reform efforts this committee is undertaking are critical, and I look forward to answering your questions.
Chair wishes to apprise all members that there is currently a 10-vote series that has begun on the floor. We will clear one more witness in recess, so Mr. Pollack, keep those thoughts close. Dr. Michelle, you are now recognized for your testimony.
Chairman Henserling, Ranking Member Waters, members of the committee, thank you for the opportunity to testify here today in front of the only committee working today. Thank you. My name is Norbert Michal. I'm the director of the Center for Data Analysis at the Heritage Foundation. The views that I express in this testimony are my own, and it should not be construed as representing any official position of the Heritage Foundation. So it has been 10 years since the GSEs, Fannie and Freddie, failed and were placed into government conservatorship, yet Congress has failed to enact legislation to reform the housing finance market and protect taxpayers. And while many seem to be encouraged that Congress appears headed toward a bipartisan reform package, Americans should be scared. Legislation such as the Bipartisan Housing Finance Reform Act of 2018 is built upon a naked giveaway to special interests from the housing and financial industries, and nothing more. And it's dangerous because these so-called reforms will perpetuate and exacerbate the worst parts of the current housing finance system. Americans deserve better. The key component of these so-called reform packages is an explicit government guarantee for mortgage-backed securities. This mechanism simply means that the federal government will begin explicitly guaranteeing the principal and interest payments on otherwise private investments and forcing borrowers to pay for it, all for no real public purpose. Nominally, these guarantees are marketed as necessary for creating a sustainable housing finance system, but government guarantees to private investors do exactly the opposite. They create excessive leverage and overinvestment precisely because investors no longer have to pay close attention to risk. Sadly, history clearly shows that these guarantees are not necessary to sustain the housing market. During the last 5 decades, the U.S. achieved a stable rate of homeownership of approximately 64% without these guarantees. And the only major deviation from that rate was when wrong-headed government policies were enacted with the express intent of arbitrarily raising the rate to 70% by increasing implicit guarantees. Predictably, that scheme did not work quite as intended and ended in a spectacular failure. There is no doubt that the constant expansion of the implied taxpayer guarantees helped to create excessive debt in home building leading into the 2008 crisis. Doubling down by making these guarantees explicit is destined to end just as poorly. All sorts of special interests have been spending the last few years on Capitol Hill, scaring everybody, as well as people on Main Street, so that they can secure additional funds for their clients. But the truth is that robust home ownership in the United States was established long before the government became heavily involved in the housing market. From 1949 to 1968, the year that Fannie was allowed to branch out and purchase non-government insured mortgages, government-backed home loans never accounted for more than 6% of the market in any given year. Yet, the home ownership rate was 64% in 1968, virtually identical to the current rate. There simply is no compelling need from either existing or potential homeowners' perspectives for these guarantees. Borrowers and lenders like to take risk because it provides the possibility for a future financial reward. Shifting these financial risks onto taxpayers, and that's what we're talking about doing, causes systemic risk and financial crises. And it seems that many in Congress have forgotten this lesson, even though it was crystal clear in 2008. So for the sake of completeness, shifting these risks onto taxpayers is why investors don't care what's in their portfolio. It's what creates excessive leverage. It's what creates overbuilding in the housing sector. And it's what pushes home prices to unsustainable levels. The results will be just as tragic next time if, in fact, we have forgotten this lesson. It is almost inconceivable to me that Congress is actually contemplating a repeat of this mistake. The Bipartisan Housing Finance Reform Act of 2018 does revoke the charters of Fannie and Freddie and run them through receivership, and that's a great policy idea, but there's little else to like. And as I intimated in my written testimony, if this is the best that we can do, Congress should do nothing.
Gentleman yields back pending completion of the votes on the floor, which, if roll call votes are called in each and every one, could take up to an hour. Panelists are asked to stay nearby, but there is plenty of hot coffee in the Longworth cafeteria. Otherwise, the committee stands in recess.
The House Financial Services Committee taking a break now, as you heard the committee chair say, to head over to the House for a series of votes. The House last night approving the Senate's short-term government funding bill that provides the over $5 billion President Trump requested for a border wall with Mexico. The Senate will take that measure up today after they gavel in at noon Eastern. You can watch the House on C-SPAN as those votes are conducted and see the Senate on C-SPAN 2. While we wait for this hearing to resume, a discussion on the Trump administration's decision to leave Syria. This discussion from this morning.
We want to welcome back Mark Ginsburg, served as a U.S. ambassador to Morocco, a former senior advisor to President Carter, and currently senior diplomatic advisor with the